Good morning and welcome back to another episode of Weekly Review of Indian Equity Markets. So, before we head into the discussion, let me give out the standard disclaimer. I'm not a SEBI registered investment advisor, so all the instruments that we discuss here and price action around these instruments are purely from a perspective of reading the market action for the week and some historical charts. This is not a recommendation to buy or sell. Please do contact your investment advisor to act in the markets. So, with that, let's begin the conversation. So, Nifty, if you see the weekly chart, which is reflected out here, very clearly Nifty is forming has formed a doji candle for the week, which essentially means that the both buyers and sellers were not able to take the prices either higher or lower. However, if you see, there's a element of tail and wick in this candle, and there's a very low level of activity in terms of the fact that candle body is missing, which means that the trading predominantly was dispersed across this range of 21,500 and 21,830 kind of levels, uh, with no clear winner on either direction. This is on a weekly chart, but I think we made a higher high. So we breached the previous week's candle and tried to go higher, but there was definitely some selling pressure coming from the top. So this is what we notice as far as weekly candle is concerned. When you look at the weekly volumes, there's some bit of expansion as compared to last week. So despite a very decent wide range candle last week, uh, we see volume expansion this week, but the volume expansion has not been able to take the candle higher, and also the body is missing, which means that this in this range in this week or in this level of 300 350 points, we have seen some bit of selling across the board. When we convert this into a daily candle, what we see is that though the candles there's some kind of expansion, while we should not consider or construe this as a final call, but there's some bit of candle expansion seen on the downside. And when you look at the Thursday, which was also weekly expiry, we see that candle range was not strong. And on Friday, though, we closed higher, but again we see body of the candle missing, which essentially means that there's some, while buyers were trying to take the prices higher, there was equal amount of pressure being exerted from the top, and hence the candle open and close was very close to each other, or almost at the same point. So this looks like a doji cross on a daily basis, whereas on a weekly basis we see some micro body of a candle visible. Now, when you look at this chart and try and evaluate as to what is happening, we formed a higher high right at the opening day of the week, which is 1st of January, on back of low volumes. And then the volume started coming in. So Tuesday's closing was definitely positive, given that we see a long tail. And then we saw downward pressure on Wednesday, followed by small body on Thursday, and almost no body on Friday. So the texture of the market is definitely that of uh, some bit of selling is something that we are seeing, especially in case of Nifty, and so there's some consolidation, element of consolidation we are seeing in this 400 points range, which has to resolve itself. So at this point of time, we are not calling calling out uh, either a bullish or a bearish point of view, but we are just trying to analyze what is happening, what has happened over the last 5 days. Uh, uh, I believe the pressure is slightly higher on the downside rather than on the upside. So that is how I would read the candle. And then when you move into hourly candles, this would be January 1st. Yeah. So this is January 1st. If you see, the range expansion is visible on the downside as compared to upside. You look at the volume pickup here, but the range is fairly small. And again, these micro candles that you see on hourly are nowhere closer to the size of the body that you're seeing when there's selling taking off. So there's some amount of money being taken out of the table or taken off the table. At least that is what we can interpret from these candles. But having said that, the buyers have been able to again build back some bit of or show some bit of strength, though it is happening in a very insipid manner, if I were to call it. So it is not a clear buying pressure, but when the selling is happening, the candle bodies are expanding, which means that with some element of downward pressure, you'll see definite uh, stronger candles getting printed on the downside, unless we take out this region with a nice upthrust candle. So for the time being, we've marked out some kind of consolidation range, and this possibly can be considered as pivot. A break of 21,500 would definitely, with a wide range candle, would definitely mean uh, additional pressure on the selling side. See something like this. So this is the kind of texture of the market that we are dealing with. Let's try and add a couple of indicators to this and see what it shows. So 21-day moving average is at is at again 41, 400, 50, 300 kind of levels, 350, 400 kind of levels. So this is where the 21-day moving average is, and the trajectory is, the angle of ascent is close to 70, 60 to 70% kind of number, degree kind of number, and it's still moving higher with a lot of strength. Having said that, a first test of 21-day moving average or a breach of moving day average with wide range candle can definitely would definitely call for some element of caution. See something like this, something on these lines uh, cannot be ruled out. So one needs to be focused, a lot more cautious in terms of the way candles get printed, and keep an eye on the way candles are getting printed, and then accordingly be aware of the situation. Um, Now we are not working with 50-day moving average because 50-day moving average is fairly far away, and if one were to wait for 50-day moving average to show up, it can definitely cause, like, it is almost 10%, 7-8% away, I guess. Yeah, 6% away. The 50-day moving average is close to 5.5% away. If one were to kind of wait for this kind of pullback to decide as to what kind of action one needs to take, it can be a little late. So there is always a probability that we may kind of test 50 DMA, stabilize there, and then move higher. But why would one want to kind of let go such a large amount of profit on the index at a broad level? More importantly, if you were to look at the independent individual securities uh, in the large cap space or mid and small cap space, for this to play out, I think you would see a much sharper correction uh, across the board. That which is what can happen given this kind of strength that we are seeing in Nifty Auto, Nifty metals to a certain extent. So those guys can pull back a lot more on an individual security basis. So I think it is important to work with a 21-day moving average or a 10-day moving average at this point of time to protect profits. Uh, if you are a shorter time frame investor, so we are bang at 10-day moving average. So that is something which will kind of which is too early, if I were to say so. I think it's best to kind of work with a 21-day moving average, which gives you some element of margin to work with, rather than being impulsive on one hand, or being very late on the other hand. So this is where you're, you should work with heightened caution. So this is as far as Nifty is concerned. I tried to summarize this before I started this. So I think I've covered most of the points here. Uh, yeah. 21-day moving average. So yeah, so we've covered most of the points that I had kind of summarized for myself before I started this recording this session. So these are the levels to kind of definitely keep in mind and work with as far as the Nifty is concerned. Now let's come to Nifty Bank. Again, Nifty Bank on a weekly basis has printed a doji, uh, and this looks a lot more doji cross than what you had seen in Nifty. Let me see Nifty, and it's similar structure, but in case of Nifty, the spread was the range of the candle was slightly lower as compared to Bank Nifty. So Bank Nifty remains a slightly better position, and if you see Bank Nifty is kind of tested out this flag breakout region. It could not take out previous week's high. It could not take out previous week high, but at the same time, uh, and also for the week, selling has improved a bit, or volumes have improved a bit. This can also be attributed to. So we will not read too much because this was a year-ending week. These two are year-end weeks, and this is the beginning of the week. So not much action is expected, which will clearly be reflected in daily charts. But if you see again, the texture of the market is indecisive candle, and some element of selling that we see. So this is there's some bit of difference between the candles which got printed here versus the candle which got printed on the Nifty. So in case of Nifty, we saw a slightly more uh, elongation or width of the candle, whereas in case of Bank Nifty, we are seeing a nice pivot which is formed, and then buyers have again come back into the action. Again, sellers tried to push it down, but buyers kind of took the prices higher. Though the body of the candle is missing, but let's work with this as a as an indication of the fact that the caution, we should work cautiously at these levels, and this is the range that I have marked out. So 46,900 is clearly a pivot which, if broken, definitely calls for heightened caution. uh, so broadly, this is how Nifty and Bank Nifty looks like. I think I did let me get back into the summary that I made. Yeah, volumes are average, volume expansion on the downside. Candle expansion is seen on downside, but buyers have been able to defend the selling pressure on hourly pivot at 47,500. Wide range breach of candle of hourly will call for higher caution. So yeah, so pretty much the way we have kind of summarized Nifty, Bank Nifty also looks similar as far as the structure is concerned, but it definitely calls for caution at this point of time. I don't think one should take fresh positions from here on unless they are very sure of fundamentals. Also, the fact that the quarterly season has begun again, and most of the large caps or coming starting this week or starting Monday, we will start seeing large caps declaring the results, and this is going to be an important quarter on from a point of view of trying to see as to how the sales growth and margin expansion is playing out, because we have consistently seen EPS expansion across the board over last many quarters. So this some bit of let off can be expected, but anything negative or sharply negative can definitely mean that the noise around valuation and premium valuations can take some bit of beating. Uh, so post the election results, state government election results of 5 states, we have seen the fact that market has priced in continuity in the government, which has also got priced in. So a lot of good news is priced in this market, and any bit of negative news or news flow around economy or uh, political attack on the current government can definitely lead to some bit of nerves as far as the market is concerned. At this point of time, opposition, there's no news on opposition, and that is definitely surprising. FMCG is one sector which continues to move higher after a breakout of this consolidation. Though this is a simple cup consolidation which happened, there's no handle around it, and then it continues to move higher. And being defensive play, there is clear advantage as far as FMCG is concerned. Let's look at pharma as well. So pharma again has moved sharply higher. There's a lot of positive news around few of the large cap pharma stocks. I think I was hearing management of Lupin Pharma, and they sounded very optimistic. So pharma has moved up sharply for the week, contrary to what Nifty and Bank Nifty has done. Let's look at the heartbeat of the market. So this is one pocket which will call for remaining ultra cautious, because the way this sector has moved significantly higher in last 5 6 years, or last 3 years, is phenomenal, and one needs to kind of be sure of what is happening in the sector and not let go a lot of profits which have been made across the segment, whether it is large cap, mid cap, small cap. So autos are one segment of market one which one should be looking out for from a results perspective as well. Now, infra continues to move higher. These are extended rallies. Look at the extension from 21-day moving average. Look at FMCG. Look at Nifty. So metal is another pocket which is showing a lot of strength, and it has broken out of a long-term consolidation or contraction pattern, and it's definitely a clear advantage as far as metals are concerned. And we've seen uh, some good metal stocks moving up sharply in last 1 or 2 weeks. IT is forming a flag on a weekly basis. You go to the IT index. IT broke out here, then moved higher. Now it is consolidating. There's nothing wrong with IT, and IT structure of IT remains much better than most of the other indices. One structure I definitely want to show, and which is very different than what you have seen in Nifty and Bank Nifty, is look at Nifty Finance. There's a contraction playing out here. It is forming kind of a flag structure, and this is much better structure when you look at this, when you compare this with a Nifty Bank or Nifty itself. So it's little early to try and put comparative comparison in place, but Nifty Finance looks a lot more stable and a lot more greener as compared to Nifty Bank and Nifty itself. These are in extended phase of rally. It's made a new high again. So we've seen most of the indices are forming a or the larger cap or the the larger money spinners are continuing to show some strength. Uh, when you look at small cap, strength is much stronger. When you look at mid cap, look at the strength. Micro cap, 4% up move. Reality is one. Look at the weekly candle in 7% index move. You convert that into daily, and you see there is some element of selling which has happened. 21-day moving average is obviously 6 7% lower, and the test of 21-day is definitely not ruled out. And given the fact that these stocks are coming out of long term of no return for the last many years, almost a decade, it, and the way we are seeing sales pressure. So these are overextended rallies on both daily, weekly, monthly, any kind of chart that you want to look at. But there is definite here advantage that is accruing to these set of companies and these set of stocks. So you should be mindful of what is happening and not hurry into taking a call. This is service sector. This is how we saw structure playing out. This is again a contraction which is playing out on a daily basis. Let me hide all the drawings. So you look at the contraction which is happening after this breakout is played out. These are better, much better structures. Nifty oil had again extended rally. So when you convert weekly into daily, in a lot of indices, we are seeing wicks being formed. Is it? Wicks can form. You can't keep having a daily up move. Uh, but the fact is, we are seeing all this playing out after an extended rally is definitely a reason to be little cautious and not go out and keep building positions, looking at people making noise in the market saying that look at what is happening to healthcare. So I think it's healthcare versus pharma. They printed similar structure. So I think apart from FMCG, which has definitely printed a much stronger candle, and small mid caps, which have which continues to draw a lot of attention and a lot of capital. Most of the other indices are showing signs of some bit of cool off. It's early to call the top. It's definitely the agenda is not to call the top of the market, but the idea is, can we have a test of 21 DMA? Do you cut all the positions now? The answer is no, because 21 DMA in most of the indices is not very far away. Uh, Obviously, we are not talking about FMCG. This is some bit of defensive, but when you look at Nifty, we're not very far away from 21 DMA. When you look at Bank Nifty, again, I think we are not very far away from 21 DMA. So let these candles print out, and then we'll see, because we've made drawn out pivots here. A breach of pivot will definitely call for some bit of action from your end. IT breach has a test of had tested out 21 DMA, and again trying to kind of has formed a pivot within this flag structure. So it's a good news. So both globally and in case of domestic markets, IT is in a much better structure. Can we breach this and move to this place and possibly test out 50 DMA? So there can be test of 50 DMA and we still remain in an uptrend, uh, and contract once again and make a higher high. So that's a probability. So this is how Indian most of the Indian indices are kind of behaving. We'll summarize the entire action once we kind of look at a couple of other charts as well. So let's look at oil. Oil is forming a nice contraction. It's still in a lower high, lower high, but now it has formed a higher low. So this is something which seems like an interesting place to look at. This is some kind of range which the oil has formed in the on the chart. Now again, if you were to look at a slightly longer term chart, long tail, long tail, long tail, it's formed on a weekly basis. If we were to kind of form this, if this were to be the pivot, then we have definitely formed a higher higher low and yet to take out higher high. But this is something which is happening in oil, and this is a move higher would definitely call for some more element of caution. India 10-year bond market is is forming a range. Let us see which direction it will resolve. But these are the long-term trend lines that we've drawn, and we should see what's happening. Now let's look at what is happening in US. So after a nice extended rally that we've seen, we are seeing some element of correction in, and we stopped right at the previous resistance level which formed in 22, and then we are contracting here. So let us see how this contraction plays out. But yeah, this can on a this is a weekly chart, so we see a nice cup formation. So can we come somewhere here, test out this breakout range, and also have a test of, yeah, so we are already testing out 21-day weekly average. And then let's see how things play out from here. But this is definitely area which is in a positive territory. We can come down till here, breach 50 DMA, shake out quite a few investors from the positions, and then start moving higher. Let's look at what is happening in Nasdaq. Nasdaq again showed similar signs, a gap down. This flag breakout played out here, and then we kept moving higher. On a daily time frame chart, we have already breached 21-day moving average. 50 is not very far away, and this is a gap area. Test of this gap would also mean a test of previous breakout range, and then let us see how things evolve from here. Is there anything else that we need to look at? Dow Jones. So the broader index, which is outside your the larger cap space in US, and a broad market index, which is Dow, is showing better structure compared to Nasdaq and better structure compared to S&P 500. So, so this is a broad reading of the market for the week. Now let me switch back to Indian markets and do a quick summary of Indian markets. So let's look at this. So, so the broad summary of the Indian markets is that while both Nifty and Bank Nifty have printed a doji candles or indecisive candle, and there's some element of volume pickup, it seems like there is some bit of advantage with the sellers at this point of time as compared to buyers. We'll have to be cautious at this point of time. This is not the end of the trend, or we are not calling this as an end of a trend, but what we are trying to kind of possibly see here is the fact that it makes a lot of sense to be cautious, not let go the profits that you have made out in this up move, and see as to if there's a breach of 20-day moving average or 21-day moving average, it will definitely call. And what is important, or what would be important to note here and try and be cautious about, is if something like this prints, and this is again, let's convert this into daily. If you start seeing wide range candle, a gap down and wide range candle, uh, and a breach of 21-day moving average with a lot of pressure, it would definitely call for you to kind of think about existing positions, how much profits you would want to kind of wager in your hope and expectation that we will see up move once again. So that's a broad call on the market. Within Bank Nifty, I think let's see few of the larger guys within Bank Nifty before we call So within Bank Nifty, let's look at what is happening to ICICI Bank. So ICICI Bank, you can clearly see on a daily chart, the pressure is on the downside. So the sellers have taken hold of the taken charge on this index, and we are already seeing a breach of 20-day moving average as far as ICICI Bank is concerned. HDFC Bank is a much better structure, but again, I think the advantage in HDFC Bank is also with sellers as compared to buyers. Let's look at SBI and we will look at Kotak. SBI, again, the sellers kind of push the price down, and then we are contracting here. The candle spread is better as compared to ICICI on daily chart. Yeah, as compared to HDFC as well. The candle spreads are better in SBI. Let's look at Kotak. Clearly, when it comes to large cap private sector banks, definite advantage is there with sellers at this point of time when it comes to Bank Nifty, and this is what is kind of causing the element of indecisiveness. So all this selling pressure is actually being absorbed by PSU guys. So we've seen what has happened with SBI. Let's look at Indian Bank. So Indian Bank is has been kind of in some bit of here again. If you see, is the seller who's in much better pace. Now you look at this. So advantage PSU. You look at this. Definitely advantage PSU. Some element of pullback coming back into the play at 21-day moving average. So I think when it comes to Bank Nifty, I think it's definitely calling for a lot more caution uh, rather than trying to take aggressive positions at this point of time in the market. So as I said, the summary is very clear that advantage is with the sellers at this point of time, more so in case of large cap banks. They large cap private sector banks are definitely seeing heightened selling pressure compared to what you see in the overall Bank Nifty. Mm, that's the true reflection of uh, where the market where the money is moving. So with that, I'll come to end of the session. Thank you once again for joining. Let me put out my quick one-liner that at this point of time, market is definitely calling for higher element of caution. Very clearly, you're seeing pressure building on the downside, and clearly evident from what you saw in top four private sector banks. As far as the Bank Nifty is concerned, uh, uh, a closer look into Nifty components will definitely give you some more idea. With that, I'll end the session. Thank you once again, and look forward to catching up next week. Thank you. Have a great Sunday.